Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with the man, myth, the legend that called the great deleveraging. We're now weeks into it. It is such an amazing call. Go look at the playlist, Mr. Greg Dickerson. How you doing, sir?
Good to see you, Michael. How are you?
Oh man, this is the topic I have been waiting for. Right, we are experiencing pain in the market. What I am looking for, however, is when does this impact the consumer? Right. As we know, statistically, quote unquote, the rich are in the stock market, right? There's I don't know what percentage of the folks that actually are in the market, but I want to know when the average consumer is impacted, because I think that will impact real estate. Right now, with it impacts crypto at the margins, stocks at the margins, probably hurts the Bay Area. But when does the consumer get nervous? When do they stop shopping? When do they stop spending? When do they start saving cash? Any ideas?
Well, from an inflation standpoint, that's already happening. That's behavior is already changing because of inflation. But when it comes to, the markets and real estate and things like that, when people's wealth starts to deteriorate, when it becomes, bear market territory. So when you start getting down 20-30% for a sustained amount of time, people start to think a little harder, change behavior, and start to get a little bit worried. And, Wall Street has conditioned people for so long to just, have the long-term vision, have the long-term view. And, it's worked. It's been great. Markets have been up on average of the history of the markets, 10% a year. I went back and looked at how much they've been up since 2009, and it's incredible. I mean, you're talking what, 1,400% NASDAQ, 400-500% Dow and S&P. When you go look at the, March 2020 run up, I think it's a couple 100%, it might be in the NASDAQ, Dow might be 100% up or something. So people have been conditioned to buy the dip, to look long view, time in the market, not time in the market, and things like that. So unless they really see a huge chunk of their portfolio go away, it's not really going to do a whole lot. Right now, but you start getting down 20-30%, when it gets like it was back in 2008 and 9, that changes people's behavior, where people have to go back to work. They have to change their budgets.
That's exactly where I'm looking at this. There is because right now we've had the great resignation. We've had more and more baby boomers retire like 2 or 3 years early. At some point, they're going to come back. They're going to be like, well, I got to get a job because my portfolio is down 50%. My house is worth 30% less, whatever it is.
Hey, my parents, I was there when they went through it. They lost, almost probably 50 or 60% in 2008 and 9 when the market tanked. They lost more than half of their retirement accounts. Their house value went down because all real estate was going down. They took it on, now they were still working and they were still earning, but they're looking at going, man, we need to rethink, retirement.
Retirement's going to be different.
Right. And, that never came back full circle. My mom ended up, she ended up basically, taking the equity out of her house because she sold her house at the peak, here recently. And, that's basically what has sustained her. That retirement account's gone, because it never came back. What people forget is when you're down 50%, now you need to be up 75% to get back where you were. It's not like you're just down one day.
100, you got to go up 100, right? You're at 100, goes down 50. You got to go up 100% to get back to 100. It's
so
crazy.
That never happened for them, even with the markets going up like it was, just because of the things that they were invested in. So now the most recent example would be what happened in March of 2020. Moving forward, a lot of people have retired early. They've retired on their stock portfolio increases, on their trading, their ability to trade, crypto, things like that. So a lot of people have exited the workforce and retired early. So if they start seeing these portfolios unwind, then you're going to have, which would be a good thing right now because there's a lot of jobs. So, they're going to have to get back in the workforce. And I've got, some clients I'm working with that, bought, crypto way back in the day, and they're looking really good. And I asked them, I said, well, what would you do if it all just goes down to, nothing again? And they're like, we'll just go back to work.
Yeah. So that's where I'm at right now is where does this impact the consumer? Because again, as you just said, the workforce, what they call the participation rate, is down 2% from historical averages. There's 11 million or 10.7 million job openings, 3.9% unemployment, all of these things, right? But I've been doing this a while, right? So let's talk 2020, March of 2020. That fall was very sudden, very fast. And obviously the Fed came in and bailed everybody out. that was so fast and really was a V-shaped recovery that nobody really felt that, right? Nobody's I mean, I'm sure there's some people, but nobody really cashed out at the bottom, sold everything. And most people like, oh, thank God I'm safe. However, the dot-com era, that 5, 6, 7 years, there were people that retired early, went to cash, and they never came back. So it is going to be interesting because I think there's a lot of people that retired early that if this thing gets bad, we're talking 30+%. The joke I'm looking for, Greg, is my 401k is now a 201k.
Yeah,
That's
that's not a joke, but
no, that's what I didn't.
That ain't funny.
No, it's not funny, but that's when I see that in the media or I see that like on CNBC, that's when I know the bottom might be,
Yeah, we saw that 08, 09. And, and for everybody watching, this is how it happened. So, NASDAQ is probably now with that in technical bear market territory. It's probably down 20% right now from highs. Mm-hmm. You're probably 15% S&P and Dow collectively. And if you look at that, that's been chipped away over the last month. And if you go back and compare the March, not the March, but the 2008-9 crash, it didn't all fall at once.
Yeah.
It kind of did what it's doing now.
Yeah.
A little bit of buy the dip, a little bit of that. And then bam, it went off the cliff when, the banks started failing.
Exactly.
And, the equivalent to that event is the Fed coming out strong and saying, we're done. And, there's a lot of leverage in the system. So when I say the great deleveraging, it's not just the markets. There's leverage, the stock markets, there's leverage in credit markets, in the banking system. There's a 2009 banking crisis level amount of leverage out there in other ways in the system right now that is teetering. So when you think about that, that's the kind of stuff that the Fed knows that they're dealing with, and the conversations going on behind the scenes. But for everybody watching, go back and look at that, the markets and how they kind of work their way down from 2008 all the way to the March bottom. And it was March of 2009 when the stock market bottomed, during that period. It took quite a while for it to get there. It wasn't an overnight thing.
Yeah, that was the thing. That's the thing about the markets, right? If it's quick and sudden, a la 87, like Black Monday or whatever they called it, or the March, shut the economy down event, it happens so fast, so sudden, you almost can't react. You're like, wow, what just happened? Where in the dot-com era, it just was like a slow, like a death by 1,000 cuts. It was down, and then I forget who went first, like Bear Stearns went, and then this one went, and then it just,
and you get the little bounces along the way, and that's what kind of sneaks up on you. And you have Wall Street that's conditioned everybody by the dip. And, everybody thinks we're going to get that V bottom recovery, which we did in March, but that was the Fed coming out saying, look, we'll buy whatever we need to buy. We're going to prop the markets up. And, we'll see what they do this time. And, but the good news is it does create opportunity because eventually you do find the bottom. The question is, not the question, but what we know now is without the Fed intervening, you're not going to get the parabolic super cycle run that we've had since 2008-9 when QE began. A lot of people don't realize that. That's when it started. 2008-9 is when they started QE. Japan tried it before that. It didn't work out so well for them. We are at the end of that, run up since 2008-9 that we are deleveraging from. So that's when I say the great deleveraging, that's what I'm talking about. It's that, how long has that been now?
13 years.
13-year cycle that we've been in. And that's what you see in these market cycles. They're usually 14, 15 years, somewhere in that range.
Yeah, it's a lot of stuff going on. Again, you got to be following Mr. Greg Dickerson on YouTube. He puts out stuff every day. It's amazing content. Greg, how do you want them to follow you, find you?
Yeah, gregdickerson.com. All my info is there. YouTube channel, podcast, gregdickerson.com.
Thanks, bud.